How to build a diversified portfolio. If you have ever heard the phrase, "do not put all your eggs in one basket," you already know the secret to successful investing: diversification. Today, we'll break down how to build a diversified portfolio that reduces risk, grows your wealth, and helps you stay invested for the long run. What is diversification? Diversification means spreading your investments across different types of assets so that if one is struggling, another may be performing well. It is not about avoiding risk completely. It is about managing risk while still giving yourself the chance to grow your money. The building blocks. 1. Stocks, equities. Stocks give you ownership in companies and are usually the engine of growth in your portfolio. They're volatile, but over the long term, they tend to deliver the highest returns. 2. Bonds, fixed income. Bonds provide stability and income. They're less risky than stocks and help cushion your portfolio when markets get choppy. 3. Alternatives. Things like real estate, gold, or even crypto can diversify further. They don't always move in the same direction as stocks and bonds, which can help balance your portfolio. 4. Cash or cash equivalents. Having some cash set aside gives you liquidity, money that is safe and ready if you need it, or to invest when opportunities arise. Example portfolios. So how do you put these building blocks together? Let's look at 3 sample portfolios. Conservative portfolio: 60% bonds, 30% stocks, 10% cash. Great for investors close to retirement or anyone who wants stability and income over growth. Balanced portfolio: 50% stocks, 40% bonds, 10% alternatives. A middle ground for long-term investors who want growth but cannot tolerate extreme ups and downs. Growth portfolio: 70% stocks, 20% bonds, 10% alternatives. Best for younger investors with long time horizons who can ride out volatility for higher growth. The right mix depends on your age, goals, and how comfortable you are with risk. Global diversification. Do not forget geography. Investing in companies from different countries spreads your risk even more. For example, if North American markets are down, European or Asian markets might be doing better. Global diversification is easier than ever with ETFs that cover entire regions or even the whole world. So remember, diversification means combining different asset classes: stocks for growth, bonds for stability, alternatives for balance, and cash for safety. The right mix depends on your personal situation, but the principle is the same. Don't put all your eggs in one basket. In our next video, we will dive deeper into risk versus reward and how to find your investor profile. Make sure you subscribe so you don't miss it. Your financial future deserves the right strategy. Thanks for joining us today. We'll see you next Friday on FinTalk Friday, where we'll keep making finance simple, fun, and smart.